This week, we're going to do a deep dive on that US inflation print that came out last week. We'll also have a look at global inflation and US inflation. And finally, we'll have a look at growth in South Africa. We're going to start off with the latest from our Global Investment Strategy Group, GISG. This is a committee that meets 5 times a year, and the sole purpose of this committee is to come up with a risk score ranging from -3 to +3. -3 being as risk off as we would ever be, +3 indicating that we'd be as risk on as we would ever be. At the moment, the score is at -0.5, indicating a mild risk off position. And there's a set of pros and cons with regards to the market that were considered in coming up with that risk score. And if we touch on some of these, for a start, GDP growth has been upgraded for most of the countries that we track over the past few months, despite the tariffs that have now come into effect. There's a range of other things happening in the background that have actually led to upgrades for growth forecasts across the globe. And that's a plus and reason to be in part optimistic about risk assets. And in addition to that, earnings growth remains very strong, linked to the GDP numbers. We saw last quarter the earnings numbers out of the US in particular surprised materially on the upside, more than 75% of companies beating on the bottom line. It's quite clearly the case that the earnings story, certainly of late, has been pretty good. If we look at investments in AI and data centers, that's been a key driver of growth in the US, and that's unlikely to be pulled back anytime soon. And margins more broadly across the sectors in the US have been pretty strong, remaining close to 5-year highs. And there's little reason at this point to expect that they're going to materially trace back in the short term. And in addition to all of that, there's been a shift in narrative from the Fed. The Fed has indicated that they are much more likely to cut now than they'd indicated before. There is an FOMC meeting this week. The market is pricing in a 100% chance of a 25 pip cut. So all of those put together paint an optimistic picture for the market, but there are some reasons for concern, some cons to consider at the same sort of time. It's very evident that the US labor market is cooling at this point. We've spoken before about the non-farm payrolls. We'll speak about initial jobless claims in a couple of slides' time. In addition to that, the market is pricing in 5 cuts from the Fed. There certainly has been a shift in narrative, but it's not clear that they're going to cut by 5 times over the coming year, which is the current market expectation. But above all, the US market is still very expensive. On a forward PE basis, you're looking at a multiple of about 23 times at a 30% premium to the 15-year median. We look at the US market in a variety of different ways. We also look at price to book, EV/EBITDA. We look at it in absolute sense. We look at it relative to peers. Every which way we look at the US market, it is not cheap. It is expensive. And given that, and take into consideration some of the other cons we've mentioned, despite some of the good news we mentioned at the top of this presentation, we think there is still ample reason to be defensively positioned at this point. Switching to inflation, global inflation is sitting at 2.7%. We've had 37 of the 50 largest economies report the inflation numbers for last month. That's steady. That's in line with where it was last month. That's not hugely problematic. But if you look at the US in particular, US inflation has now increased to 2.9%. from 2.7%. And that's likely to be a level that's uncomfortable for the Fed. And while they may well cut this week, it does bring one to question whether they are in fact going to cut by the 5 times over the coming year that the market expects. Part of the issue is that month-on-month inflation was 0.4%. Now that month-on-month number is going to remain in the year-on-year calculation for the next 11 months, and that's going to keep inflation in the US elevated. And even if month-on-month inflation were to drop to 0.2%, which I think is a very optimistic scenario at this point, but let's be optimistic for the moment. Month-on-month inflation drops to 0.2%. Even in that scenario, year-on-year inflation is going to remain at and around 3% for the coming few months. Now, if we delve into the data and you look at shelter inflation, there's a bit of a good news story there. Shelter inflation continues to decline, now at about 3.5%. The concern for the Fed is going to be everything else. Non-shelter inflation has now picked up to 2.5%. So even if shelter inflation gets to 2%, and that's some way away, everything else is now growing at more than 2%. And that suggests that the entire basket will still be growing by more than 2% per annum. And if you look at underlying core measures of inflation, and there's a couple that we look at, if you look at core sticky CPI excluding shelter, that number is running close to 3%. If you look at core services ex-housing, that number is close to 3%. So core sticky inflation is running at around 3%. And these are the sort of numbers that would concern a central bank. And in addition to all of that, leading indicators suggest that inflation is likely to be higher still in the US over the next few months. So the inflation picture is not looking good at all. And while the Fed might be cutting because of a weak labor market, they do have to have their eyes on this inflation environment, and that's likely, should it persist, to constrain their ability to cut very aggressively. China is a completely different story. Chinese inflation at the moment is running at minus 0.4%. So when there are signs of some weakness, some of the latest data coming out of China missed relative to expectations, there's ample scope for stimulus in China, a very different situation from the US. And just coming back to the US, there's further signs that the US labor market is cooling. I did speak before about the non-farm payrolls numbers and how from that side, it's very evident that the labor market is cooling. Companies are hiring less than they did before. The latest initial jobless claims numbers, and these are claims that people make after they've been made redundant or they've been let go, those claims are now spiking. So not only are companies not hiring as much as they did before, they're actually firing more than they did before as well. And this is something we've got to keep a very close eye on. When labor markets typically get out of balance, there can be a very rapid shift. And the latest data does suggest that the US labor market is cooling quite rapidly. And with that would come a reduction in consumption and potential risk to the housing market as well. So this is something we need to keep a very close eye on, and we will provide updates on going forward. Switching to South Africa, there was a GDP print that came out last week for the second quarter. The South African economy surprised on the upside, growing at 0.8% in the quarter instead of the consensus 0.6%. So a nice beat. But even after that beat, the South African economy is still only about 3% above where it was pre-COVID 5 years ago. And it still is actually about 3% below the pre-COVID trend. So there's a lot of catch-up growth that still needs to occur just to be in line with the pre-COVID trend growth rate. The current consensus forecast is that the South African economy will grow by about 1%, and that's a very similar number for the SARB and the IMF. They're also at 1%. Treasury is a bit higher, but that number is back from the budget at 1.4%, so it is a little dated. So the current view is that the South African economy will grow by about 1%. Those numbers are very likely to be upgraded. But given the print that happened, even if the South African economy just grows at 0.1% for the next 2 quarters, the South African economy will grow at 1% for the full year. It was a very material beat. And as a result of that beat, we are going to see broad-based upgrades to South African growth expectations over the coming 6 weeks or so. It wouldn't at all be surprising if within a couple of months, we're looking again at a consensus forecast of around about 1.4% or so for the South African economy. So that should provide some tailwind for SA Inc. shares and also a tailwind for our local bond market. But in addition to all of that, we've seen a recent surge in performance from Eskom. The energy availability factor is currently sitting above 70, which is quite unusual for this time of the year. It's the highest reading for this time of the year since 2018. And very encouragingly, the primary reason why it surged is a decline in unplanned outages. And that suggests that the system is becoming more reliable, and hopefully in the near term, energy becomes less of a binding constraint on growth in South Africa. So there's a broad set of data points that suggest that we are reaching a turning point for South Africa, and the recent downgrades are likely to be reversed, and hopefully that persists. And that's where we're going to leave it for this week.